Welcome to Stock Talk with Mike. In this video, I want to talk about portfolio management, how to work around a position, how to structure your portfolio to prepare for a possible market downturn with this really hot market we've seen as of late, and then also just clear up a couple misconceptions that I commonly see amongst new investors. I really just need to get this first one off my chest. I'm just seeing it way too often. And it's a real misconception commonly seen amongst new investors that X stock trades at way too high of a share price and it's too expensive for me to buy. I'd only be able to buy a few shares or only a fraction of a share, as if that somehow has something to do with how expensive or how that company's valued. You look at an example like shares of Ford, ticker F, right? It trades at over $10 a share. It has a market cap. So that's the real value of a company. The number of shares outstanding times the share price gives you that market cap. And its market cap is $45 billion. So a fairly big company. And then look at a company like, say, totally unrelated, but iRobot. It trades at $133 per share. Much higher share price, but its market cap is $4 billion. That's like Ford is 11 times bigger than iRobot, even though it trades at 10 times the share price. So it really has nothing to do with how expensive a stock is. And as far as new investors picking up shares, I mean, nowadays you can even buy fractional shares. So it totally doesn't matter. It's totally irrelevant how many shares you buy of a particular company. All that matters is that share price times how many shares you buy, what your position size is. If you want to look at if a company is expensive or not, that is not a metric. You might want to look at the market cap and compare it to other companies in the sector, because it might give you an idea of how much room there is to run. Granted, yeah, definitely, it's going to take more for a company that's $1 trillion market cap to grow exponentially from here versus a smaller company. So I often like to first look at the market cap in a company, its true value, and determine how much room it may have to run, right? If it's in a massive industry with a huge addressable market, and it has a very small market cap, there may be a lot of upside potential in that company. And that's where I would start. Other ways of looking at the value of a company, or if it's expensive, it's not the share price. The share price, as it moves, will change its value, but it itself is not a measure of its value against its peers. So you want to look at maybe its price to sales, or look at its PE ratio, so its share price against its earnings per share. But yeah, you never want to just look at the share price to measure how expensive it is. I apologize if you know all this stuff, but I think for new investors, that can be a little bit confusing. So I just wanted to clear that one up. So it might not be as exciting as talking about individual stocks, but portfolio management is probably almost equally important as far as beating the market over the long term. So there's a couple things I want to talk about, and I want to focus on letting your runners run and the good and the bad with that strategy, and how things aren't typically that black and white, at least in my opinion, as far as how you should be handling your long-term holds as a long-term investor. So I think for sure, a lot of new investors are way too focused on the short term, like wondering why a stock has dropped 2% or that it's just recently run up, so they really like that stock. And I think really buying good companies and not paying attention too much to the market noise and holding them through even the turbulent times, or even maybe adding during the turbulent times and holding them for the long term, is the best way to achieve market beating returns, right? There's definitely short-term opportunities for swing trades and some speculative investments that might pay off in the short term, but I'm talking beating the market sustainably over the long term. When it comes to letting your runners run in particular, what people mean is buying a good company and then not selling it, letting it actually accumulate and grow in your portfolio. But I think portfolio management needs to come in play. Like, let's look at a 1-year chart of Tesla, actually specifically just looking at 2020, where it ran from $90 a share to over $900 a share. So that was about a 900% return. So if you owned shares of Tesla during that full year, you did very well. And if you let your winners run and you didn't take any profits along the way, you did extraordinarily well. But let's take the hypothetical scenario where maybe you originally bought $1,000 of Tesla and your portfolio was worth $10,000, and you had about a 10% weighting of Tesla in your portfolio. Well, that may have grown, assuming your other stocks also performed fairly well. That position in Tesla may have grown to 30 or even 40% of your portfolio by the beginning of 2021. And I think the mental exercise is that for looking to the future, you need to look what's going to happen next. So does the fact that Tesla has run up 900% make it more attractive now as a future investment? So why would you wait at only 5% at the beginning of last year when it was way undervalued? That now it's gone up 900% in 1 year, you think it's more likely to beat the market. So you have such a heavily weighting in your portfolio. That strategy makes no sense to me. I think portfolio management needs to come in play, and the way to look at it would be to weigh it appropriately in your portfolio against other stocks. And I'm not saying to sell out of a company that you have belief in that's run up. I'm saying maybe take some profits and look for other outsized opportunities. You look at Kathy Wood and ARK Invest and how they've managed Tesla over the years, and they had quite a bit of questioning around why they were selling shares of Tesla, in the early part of 2020 and whatnot as well. And Kathy Wood has been quite clear that they maintain a maximum 10% weighting of Tesla in their portfolio, even though they're very bullish on Tesla, and that was just sound portfolio management. I kind of agree with that strategy. Keeping my most bullish stocks, my core holdings, I generally wouldn't have them be more than about a 10% weighting in my portfolio. And by doing that, you still get to benefit largely from its upside. I find it interesting is that in recent weeks, we've actually seen a little bit of a sell-off in Tesla, right? It's gone down from the highs of 900 down to closer to 8. And recently, and Tesla's always been for all of last year, a solid 10% weighting in the ARK Innovation Fund. And right now it's actually declined a little bit. So they haven't aggressively added here in recent weeks, which is interesting. So Tesla is now about an 8.6% weighting. So even though it's dropped a little bit, they haven't aggressively added to that position. And I think that actually makes a lot of sense given the massive run we've seen Tesla on. It doesn't mean you're not bullish on the company. I think it just makes sense from a portfolio management perspective. On the total flip side, I think it's completely okay to add to a position in your portfolio, even if it means dollar cost averaging up, particularly if it's under allocated in your portfolio, like it's a light weighting and you'd like to make it larger, or you've seen a large significant sell-off and maybe you still believe in the underlying fundamentals and think the company is going to do just fine. And I look at an example for me would be Square. I originally bought Square in August of 2017 at $25 a share. And since then, that position's gone up around 1,000% or so to today's values. But you look at my brokerage account, it looks like my gains are nowhere near that, maybe 500%. And that's because I've added along the way. And I have sold at some peaks as well, just to maintain roughly a 5% weighting for me of Square in my portfolio. That's kind of roughly where I wanted it. I don't over micro trade these, but I look for large, big events that change the share price to maybe add or to sell. But I don't let the share price and the price action determine how heavy of a weighting it is in my portfolio. Just because a stock goes up 1,000% doesn't give it a right to be now 30 or 40% of my portfolio. It doesn't make it more likely to be successful down the road, in my opinion. That might be a time to lighten up a little bit its weighting in my portfolio. And I find that to be a really good strategy. So with Square, I originally bought it in August 2017 at $25 a share. And over the next year and a bit, it rode up to over $100 a share. And I just held on to that core position because I was still really building out my portfolio and adding funds at the time. So I wasn't looking to sell much. And that's a big part of it as well. And actually, I did take some profits a little bit. February of 2020 at $85 a share. I trimmed it back a little bit. And that was actually quite fortunate. And, I honestly, that might have been a little over trading there. I probably didn't need to sell any. But anyways, in March of 2020, as it was dropping and and a lot of negative sentiment there with COVID and everything else, and I didn't wait for a bottom, and I didn't care if it kept going down. I knew it's a good company that I still wanted to generally net accumulate over the long term. So I bought in early March at $75 a share, right? And added back those shares I originally sold at 85. And then actually it was the next day, it just tanked even more. And I bought more at $65 a share. And then it continued to tank. So I didn't know what I was doing, right? It sold off to, I think, $35 a share. I didn't know where it was gonna bottom. I just know it was irrational far decrease in share price. I thought Square was going to do just fine in the pandemic and they'd come out the other side. And sure enough, we've seen that. It was a great buying opportunity. Even though I didn't catch the bottom, I didn't wait. I knew it was a decent entry and I purchased. And I have sold along the way a little bit trimmed as it's shot up all the way from 35 to 272. I have sold a little bit in the 200s, but it's sitting right now at about a 6% weighting in my portfolio. It's one of the larger positions in my portfolio, and I'm happy with that. If it got to 10%, I'd be taking significant amount off the table with Square, even though I really like the company for the long term and plan on continuing to hold it. And I call this working around a position. I think it's okay to do that. You don't have to have an all or nothing approach. I see a lot of people like, that's it, I'm out. I'll get in, and when it drops back down to, well, what if it doesn't? And if it's a good company you believe in the long term, I think you should stay invested in it, at least in my opinion. And you'd be better off kind of working around that position. Because I think moves to the upside and downside can be just a little bit irrational and overdone at times, right? I look at a company I like, and when it moves a few 100% in 1 year, that may be kind of pushing above the underlying fundamentals for the company. So it might be time to take a little bit of profits. But doesn't mean I want to completely sell out, because I do want to still participate on any upside. So using this strategy of trimming my winners just to keep them appropriately weighted in my portfolio, and with it just being difficult to find good value stocks to buy right now, it's definitely caused me to build up a fairly significant cash position, which I'm comfortable with. Given the big run we've had on, I probably have a larger cash position now than I've ever had, ready to pull the trigger on any significant pullback, either adding to some of my core holdings if any of them sell off by 20% or more, or maybe picking up a new stock off my watch list. So just a few random thoughts I have on portfolio management. I think it's way too easy to get caught up in the short-term price movement, whether to the upside or downside. And I think it pays off for investing to have a long-term view. And I think you have to remember why you bought a stock in the first place, right? If it's a long-term investment that you think is going to be a much larger company many years from now, it pays largely to just hold that core position and not sweat the short-term volatility too much. Versus if you're buying for a swing trade or a quick speculative play, yeah, you might want to pay more attention to the short-term price action. So that's all I have for you today. Thank you so much for watching, and happy investing.